You're in your Business and Finance Straight Talk magazine, Point and Issue. I'm Bob Harris, and again we are talking stocks. And with me are Gerald Johnson and Sharon Whitelock from JN Fund Managers. Straight off the bat, what have been the performance of some of the stocks?
Well, Bob, most of the stock on the exchange have been doing very well over the last couple of years. And if you look at the table that we have on the screen now, you'll see that some of the top 10 stocks have given very good returns over the last couple of years. We see Lascelles offering investors over 1,000% return since 2001 to 2007. Now that, Bob, works out to a compound annual growth rate of 48.3%, which means that investors in this, on average, if you average it out throughout the years, would have been getting a 48.3% returns on their investment each year on average. Life of Jamaica offered similar returns, over 1,000% returns over the period, which works out to be a 42% increase over the period on average each year. And if you put that in context of an investment, Bob, 100,000 invested in Lascelles at 2007 would have been valued approximately 1.5 million. The same for Life of Jamaica, 100,000 invested in 2001 would now be valued at 1.1 million. And for Jamaica producers, same 100,000, you'd now have over $600,000 in terms of equity investment. So the stock market, or the performance of the individual stocks, have really been tremendous. And if you look at the entire listing of companies on the market, Bob, what you'll see is that all of the companies, with the exception of 4, gave positive returns to investors. And all of those that gave positive returns, with the exception of about 3 or 4, all of them gave returns over 100% for the period. So the market has been doing very well. And lest we forget that there's a downside to the market, there's also a table of some of the companies that where investors would have seen negative returns on their investment. So Siboney, Dial, Cable and Wireless, Goodyear are companies, or they're the only 4 companies that offer negative returns to investors over the period. So you would have seen a 96.2% decline in your value if you had Siboney. Dial 94%, well, we all know what happened to Dial. Cable and Wireless 61, and Goodyear, you'd have been down 10.5%.
Now, one of the scary things about stocks, as was pointed out by the information you shared with us, is that an individual stock might do well, an individual stock might not do so well. What about performance of a stock that provide good indicators as to whether to buy or sell?
You look at the fundamentals of the stock. Is this a good company? Is the management team of the company a good management team? You look at the intrinsic value of the company itself. Is there value at this price? Because one of the things, Bob, the difference between a good company and a good investment is the price that you pay. So you have good companies that you can buy into, and if you get them at a good price, that's an even better investment.
How do you determine a good price?
You can't use the value alone. You have to look at all the other factors, the liquidity of the stock, how easy it is to get into and out of that stock.
How does one go about investigating that kind of information?
This is where your investment advisor comes in. He or she would have access to this sort of information and would be able to advise you accordingly. So they will know whether a stock is undervalued, overvalued, based on all the fundamentals and all their technical analysis of the stock, and they'd be able to advise you accordingly.
How does an investor navigate around a market that at times behave in an apparent erratic manner? Take Salada Foods, for example. In 2005, it had a negative 50% decline. Then the next year, in 2006, it had a 299% performance.
So how would you have felt if you would have sold?
Exactly.
Right? But there's a wave that happens in the market. And so, but the wave, there's a trend, and the trend is always up. So even though you've got the peaks and the valleys, and where the market may go 30% down or 50% down, it's going to come back up much more than it went down. We look at the performance of the American stock markets. Since 1946, when the market has gone into a decline, it's on average gone down 30%. Subsequently, it's increased on average 150%, right? And you look at you can even look at the time span of that happening is on average 18 months, sometimes the longest I think has been 38 months. So there is an ebb and flow of the market, but it's not timing it, it's time in the market. So I encourage investors, you know what, when we go into this, let's form a plan. What are our objectives? Because even though the market goes into a decline, has the fundamentals of the company and the reasons why we bought them changed? Salada. Did Salada stop selling coffee? Did people say, we don't want Blue Mountain coffee anymore? Right? So the fundamentals of who they were still good. I mean, I don't think management changed significantly or anything like that. So it was just a factor of what was going on in the market at that time.
When we come back from the break, I want to look at some current trends, what the market is doing, and also we want to touch on the issue of devaluation and inflation. You're watching Point and Issue. We'll be right back.